Coming to you live from the palatial studios of PBJ Productions. Welcome to Patrick and BJ Talk Real Estate, where we talk about life, the universe, and everything as it relates to real estate. Hey everybody, it's BJ.
And Patrick.
And hey, we have a special guest with us today, David from Olympic Mortgages. He's going to tell us how the government of Canada is going to save us all.
Well, in this episode, I'm already laughing, right? But
is this the last hurrah?
Will the Finance Minister of Canada save us with the Mortgage Charter? That's what we're going to be talking today. Well, the Mortgage Charter is supposed to be there to help Canadians from the Mortgage Renewal Cliff. Coming to us. What is it? In the next 3 years, 18 million people are going to be renewing their mortgages. But you know what?
At 7%?
I don't know. We'll see, right? That's unpredictable. But we're going to let David explain to us, what is the Mortgage Charter anyways?
So David's going to pontificate for all of us.
Yeah. Right, so, because you're the expert. I don't do mortgages. I just read about it.
Yeah, so what is the Mortgage Charter? Let's start with that.
The Mortgage Charter is sort of like a guideline that the government of Canada is putting towards the 6 big banks and all the lenders out there to give Canadians a break on their mortgage payments if they're having financial difficulty, especially. So one of the main aspects of the Mortgage Charter is, I'm just reading it directly off my phone here, allowing temporary extensions of the amortization period for mortgage holders at risk. And this is the biggest one, guys, because basically extending that amortization out for, from 30 or 25 or 30 years to 40 years can shave off, hundreds of dollars off of a mortgage payment.
Sure. And
bring that payment down to within where that client, was near starting out at. So that client will then be able to handle their mortgage payments. They'll be able to handle their mortgage payments
a little bit easier.
So is that a temporary measure? Would they go back to the shortened term afterwards, or once it's done, it's going to be for 40 years, let's say?
I'm actually just learning about this myself and hearing from a few clients of mine. There's actually, the banks now have specialized departments that deal with mortgage holders that are quote unquote at risk. Mm-hmm. And the people in the branches don't necessarily refer their clients to that specialized help desk right away. So you specifically have to ask for it. But as far as I've been hearing so far, clients have actually been getting granted amortizations up to 40 years, and they'll leave the mortgage at that until that client pays off that mortgage or transfers it to another lender. So no, it's not just a temporary measure. Actually, they will leave the amortization at the 40 years. Okay, so does that mean? So let's say I'm coming to you for a new mortgage. Mm-hmm. Does that apply to me? That I can say I want a 40-year amortization, not 25? No. It would. The most amortization we can do on a AAA lending mortgage is 30 years, and I can't offer you a 40-year. It's just on an existing mortgage. If you have. And you'll have to go through a little bit of an obstacle with regards to proving to the bank that you're at some sort of hardship.
Is this different from someone who is, let's say, on a variable rate and they've hit their trigger rate where they're only paying interest now? How does that affect them, or does that affect them at all?
The trigger rate is essentially when a client's mortgage payment isn't actually covering the interest.
Oh, not even
covering the interest. And that's when that's when banks in some cases will contact that client and raise their payment up so that at least they're covering the interest. This specifically, from what I've been hearing, is just really for people that are proactively reaching out to their banks.
On a renewal basis?
Not just on the renewal basis, actually. Just if a client is having hardship with their mortgage at any point in time, they should reach out to their bank. And the banker, whatever banker you get at first, is going to try to convince you to lock in your mortgage into a fixed rate, which might be lower than a variable rate, or they'll try to convince you to do a refinance application to bring that amortization back to 30 years. So if the client is on an
After the
amortization,
fact.
after the refinance,
Yeah,
yeah.
okay.
So if the client is on a 23-year amortization, then that banker is going to say, okay, well, let's see if we can apply to get you reapproved for a 30-year amortization, which is just the same as a regular mortgage application.
Yeah.
Now, I would not recommend a person do this. I would then recommend that whichever person is doing this is to tell their banker, no, those options don't work for me. I need to hear some more options, and that's when the banker will be able to sort of move you to this different department where they can extend out the amortization without any application. It's quite. I think the banks are somewhat. I think the banks are keeping it under wraps.
Yeah.
Because they don't want millions of people coming in and
Right.
extending their amortizations to 40 years.
Right.
But people should know.
So
about
you
it.
don't have to
Fair
get you don't have to get reapproved, but you do have to qualify for the hardship. Is that right?
Basically, yes. Yeah.
So on renewals, I think one of the new policies is in the charter they were talking about if you're renewing your mortgage, you might be able to go to another lender without requalifying on a renewal.
So this
is that correct?
This actually isn't related. That what you're talking about isn't related to the mortgage charter.
Okay.
It's just It's just I don't know. It's just new regulation basically saying that because that client originally qualified for an insured mortgage, so it has to be the original mortgage has to be a CMHC insurance, CMHC, Sagan, or Canada Guarantee insured mortgage, and only if that is an insured mortgage can that client go to another lender and not have to requalify under the stress test.
Under the stress
They'll
test,
have
okay.
to requalify at the contract rate. So whatever rate they're going to be
That's
getting
available. Yeah.
versus their rate plus 2%.
Is there any? I'm curious about this. Is there any pros to doing that, from jumping from your original lender to a new lender?
Only if, in that specific situation, the only advantage to doing that is if the new lender is giving you a much lower rate.
Right, where a renewal rate, sometimes you have to sort of take what they give you.
Exactly. Well, or you negotiate.
Yeah.
So what I usually do with my clientele is I say, okay, go to your existing lender, ask them what their best rate is, and then, they get their rate, and then they come back to me, and then, I compare that rate that they were given by their bank to whatever rates I can get at other various lenders and see if a move makes sense for the client.
Okay, that makes more sense to me, because I didn't understand everything that Freeland was talking about.
Okay.
I'm just sort of remembering the highlights. So I'm glad you're clarifying that for me, and of course for everyone else at the same time. Is there any negative effects if you did that? If you jumped from one lender to another during from your renewal period?
No, there's nothing. There's no negative effects. Generally, if we're moving a client from one lender to another, it's because the client is going to be saving a significant amount of interest. So that I feel like is an advantage. The client's amortization stays the same. Their payments will change to whatever the new interest rate is. So
it
that
might
will
not be a
change.
bad idea to at least look at what your options are at that period.
Exactly.
At that time.
I mean, everybody should always look at what their options are.
Move to Switzerland.
Move to Switzerland. Yeah, maybe. I think Switzerland is maybe even probably more expensive, much more expensive. But Switzerland sounds nice.
It's more economically. There's less economic boundaries there. How's that?
Declare private citizenship.
I think that's quite the involved process.
I don't know anything about. I just know the surface. I'm not going to get into that. Right, but for mortgage charter, what else was some of the highlights there?
I'm just gonna bring it back up here.
Yeah.
Because I can't memorize things. The rest of it, honestly, is very. Actually, you were right. It says not requiring insured mortgage holders to requalify under the insured max minimum qualifying rate when switching lenders at mortgage renewal. So you got me there.
I remember things sometimes.
But the rest of it is basic. The rest of it is
As long as you remember
basically.
your kids' names, I guess.
He's got that.
I've got enough kids to remember,
Yeah.
right? So people ask me what grade are they in. I don't know, right?
Yeah.
I know how old they are. How about that?
And the names, right?
And their birthdays mostly.
Hey, you? Isn't
Hey, get to work.
Yeah, get to work.
Right.
Do the
Get out of bed,
dishes.
go to school.
Yeah.
or name them all the same thing?
At least I'm not like Elon Musk naming like I don't know what
Their
that kid's-
babies. Yeah, weird names.
Yeah,
Yeah.
This is Daryl. This is my brother Daryl and my other brother Daryl.
Huey, Dewey, and Louie.
Those are different.
I know, but that would be a good strategy. All right, we're getting way off topic, right?
Getting off topic, that's okay.
Yeah.
So about the mortgage charter, the rest of it is basically quote unquote toothless. Waiving,
Toothless?
well, toothless. Waiving fees and costs that would have otherwise been charged for relief measures. I haven't heard of any costs that banks are coming up with regards to these relief measures. Contacting homeowners 4 to 6 months in advance of their mortgage renewal
Don't
to
you do that?
inform them of their. I mean,
Don't
banks
you-
already
I
contact
was
their
gonna say,
clients
isn't that
4
a
to 6
normal-
months before
Yeah,
renewal, so
right.
that doesn't mean anything. Giving homeowners at risk the ability to make lump sum payments to avoid negative amortization. Okay, well, most banks give their clients the option to pay down a lump sum of 20% on the balance per year.
Yeah.
But in this case, this doesn't really. It doesn't. If a client had money to make a lump sum payment, then they would equally have their money to make their more regular mortgage payments.
They wouldn't need a relief.
They wouldn't need any relief
yeah.
if they had a big savings account to be
Right.
able to plunk onto the mortgage. But it does say also here that if somebody sells their principal residence, they might be not have to pay the prepayment penalty. So I haven't heard of this happening yet, and I don't know how lenient the banks are going to be with regards to waiving a prepayment penalty. Because
So a prepayment penalty is not the same as like I've sold people's houses before, and they're like in the middle of their fixed term contract,
Yeah.
and they have a penalty to extinguish the mortgage.
Yes,
Is that the same?
that's
thing?
the same thing.
Okay,
So this could be a very big deal, actually,
that
because
could save tons of money.
it could save tons of money. But I haven't seen this. I haven't seen it in practice yet.
So, but this charter is a recommendation, not the actual bank, like the big national companies. It's not their actual policy.
It's a recommendation. It's not their policy.
Yeah,
Exactly.
so we'll
So
see.
When does this get some teeth to it?
I believe the first, just basically allowing temporary extensions on amortizations is the biggest aspect of the relief here. So
Is that live or is that just?
it's already happening.
It's happening.
Yeah, it is.
Do you think that will give as those 13 or however many million people are renewing the next 3 years? Do you think this will make a significant difference? Let's say to the real estate market, to people's pocketbooks.
I don't think this necessarily is going to make a huge, gigantic difference because from what I'm seeing on my desk right now, when my clients come through, yes, they are unhappy that their mortgage payments have gone up or that their rates are going up significantly. But because the stress test has already been in place, those folks already qualified for a higher mortgage amount. Or a higher mortgage payment, I meant.
Okay.
So because the stress test has been in place, I haven't been seeing across my desk a bunch of our clients having great financial difficulty. Yeah, it's annoying.
Yeah.
It's for sure annoying. There's a lot of clients of mine that have to cut their discretionary funds, maybe not go on a vacation this year because the mortgage payment is higher.
Yeah.
But that's not being able to put food on the table.
Are you recommending certain things so people are prepared for those higher interest rates? Your clients?
Well, I mean,
Or is it already they're taking that upon themselves?
Exactly. Yeah. I mean, like I'm recommending to clients if they have a lot of equity, for example, I might say, okay, well, instead of putting yourself in a huge financial stress, let's see if a refinance will work and put an extra 20 or 30 grand in your pocket so that you feel okay.
Okay.
But the biggest difference I think that's going to happen over the next 6 months to a year is fixed and variable interest rates are going to fall significantly.
Okay.
They already are. So
Well, I definitely want to get into predictions, but I want to save that for the next episode.
Sure. Okay.
But yeah, do we want to wrap that up here?
Yeah, no, that's a good. I think that's real good information. There's some great stuff there for all of us. If you have any other questions specifically, put it in the comments. If you have questions for David, put it in the comments. We're also going to put David's contact information in the description, so you can get a hold of him if you want to reach out to him directly. Also, if you haven't, please take a minute, subscribe to the channel. We are putting out regular content every week, and you want to make sure that you've subscribed so you don't miss anything. You get notifications for everything that we have coming up, and hang in there with us. There's lots coming up, right?
Absolutely. Thank you for joining us, and thank you, David, for joining us.
Thanks for having me.
We'll catch everyone in the next
All
episode.
right, see ya.